Imagine waking up one morning and realizing the ground beneath the world's financial system has shifted. The rules of global economics have changed, but you didn't get the memo. For the first time in more than 20 years, the United Kingdom has overtaken China as the second largest foreign holder of United States government debt. This is not a hypothetical scenario or a far-off possibility. It is reality, unfolding right now. The ripple effects could touch every corner of the global economy, influencing everything from the value of your savings to the cost of your next home loan. To understand why this matters, let's rewind to the dawn of the 21st century. Back then, China's meteoric economic rise was one of the most transformative stories in history. Fueled by an enormous trade surplus with the United States, China amassed vast foreign currency reserves. Much of this surplus was recycled into United States Treasury securities, creating a powerful feedback loop. American consumers bought Chinese goods, and China used those earnings to purchase American debt. By the year 2011, China's official holdings of treasuries had soared past $1,300 billion, an almost unimaginable amount at the time, making China the largest foreign creditor to the United States. For American policymakers, this arrangement was both a blessing and a curse. On one hand, Chinese demand for treasuries kept interest rates low, allowing the United States to borrow cheaply and fund decades of expansion, from military operations to social programs and infrastructure booms. On the other hand, it concentrated a huge chunk of American debt in the hands of a strategic competitor. The fear was that China, if it chose to, could use its holdings as a weapon in moments of geopolitical friction. But fast forward to the present, and the financial landscape looks dramatically different. As of May, in the year 2025, total foreign holdings of United States Treasury debt have surged to over $9 trillion. That's an increase of more than 11% in just the past year, a testament to the world's ongoing appetite for what many still see as the world's safest asset. But there's a twist. China's piece of this massive pie has shrunk to only about $756 billion, a level not seen since before the global financial crisis of 2008. For context, that's a 15-year low for Beijing's official stake in American government debt, a dramatic drop from its peak just over a decade ago. Meanwhile, the United Kingdom has quietly surged ahead. Over the past 10 years, British-based holdings of United States Treasuries have tripled, now approaching $780 billion. This shift has propelled the United Kingdom past China into the number 2 spot among America's foreign creditors, trailing only Japan, which remains firmly entrenched as the largest holder. However, these headline numbers tell only part of the story. Beneath the surface lies a far more complex and nuanced reality. As Alicia Garcia Herrero, chief economist for the Asia-Pacific region at Natixis, observes, China has been selling slowly but steadily. This is a warning to the United States. The warning has been there for years. It's not sudden. The United States should have acted on this well before. Her insight reveals that China's retreat is not a sudden stampede for the exits, but rather a calculated, long-term strategy. Why the change of heart in Beijing? The answer is a blend of economics, politics, and strategic foresight. Over the past several years, China has systematically diversified its reserves, reducing its reliance on United States treasuries. Instead of funneling the bulk of its surplus into long-term government bonds, China has shifted towards a mix of assets, including United States agency bonds, such as those issued by Fannie Mae and Freddie Mac, and, significantly, a surge in gold holdings. Simultaneously, China has shortened the average maturity of its treasury portfolio, favoring short-term bills that can be sold quickly in a crisis. Brad Setzer, a senior fellow at the Council on Foreign Relations and former United States Treasury official, sums it up. There is no doubt that China has shortened the maturity of its United States portfolio. This shift has enormous implications. When a major player like China steps back, demand for treasuries weakens. The result? Yields on these bonds climb, which pushes up borrowing costs, not only for the United States government, but for borrowers all around the world. This is no small matter at a time when the United States national debt has already soared past $35 trillion, a figure so large it stretches the imagination. For every percentage point increase in yields, the cost of servicing that debt rises by hundreds of billions of dollars annually, squeezing budgets for education, defense, healthcare, and more. But the risks don't end at America's borders. United States Treasury yields set the benchmark for interest rates worldwide. As these rates rise, so do borrowing costs for governments, corporations, and households everywhere. Mortgages become pricier, business loans harder to get, and credit card rates climb. The cost of money itself increases, adding friction to the gears of the global economy. This is why shifts in Treasury demand matter not just to Wall Street, but to Main Street and beyond. Yet a deeper layer complicates the picture. The true extent of China's holdings is cloaked in secrecy. While official data shows a marked decline, many analysts believe China is increasingly using third-party custodians, especially in financial hubs like Belgium and Luxembourg, to obscure the true size of its exposure. Euroclear in Belgium and Clearstream in Luxembourg have reported notable increases in their treasury holdings, and some experts suspect that a significant portion of these assets actually belong to China, held through complex structures to avoid direct scrutiny. This opacity makes it far harder for policymakers and investors to gauge Beijing's real influence over the market. Meanwhile, the United Kingdom's rise is less about British economic policy and more about London's role as the world's financial crossroads. The City of London has long been a safe haven for international banks, hedge funds, and institutional investors. Many of the treasuries attributed to the United Kingdom are actually held on behalf of global clients, funneled through British custodial accounts rather than owned by British entities. In this sense, the rankings reflect not just national economic power, but also the architecture of global finance. London's infrastructure, legal system, and time zone make it the perfect bridge between the Americas and Asia. This unique position has helped transform London into a true global clearinghouse for capital, a role it has played since the days when the British pound sterling was the world's dominant reserve currency. Consider this. In the 19th and early 20th centuries, the British Empire's pound sterling was the world's currency of choice, supported by London's unrivaled financial networks and colonial reach. After the devastation of the Second World War, the dollar took over, but London retained its status as a global financial hub. Today, that legacy endures in the city's ability to attract and manage international capital, even as its own economy is dwarfed by larger powers. So what happens if China accelerates its retreat from treasuries? The consequences could be dramatic. Should Beijing decide to sell a larger chunk of its holdings, yields would spike, forcing the United States Treasury to offer higher rates to lure new buyers. This would increase the burden on American taxpayers and could spark volatility in financial markets worldwide. Experts warn that such a move would be like raising the cost of oxygen for the global economy. Everyone would feel the squeeze. Alicia Garcia Herrero describes China's steady selling as a warning light flashing on the United States dashboard. It's not an apocalyptic scenario, but a cautionary signal about complacency and the dangers of excessive reliance on foreign capital. In recent years, the United States' dependence on external financing has grown even more pronounced. Persistent budget deficits, driven by rising entitlement spending, tax cuts, and costly emergencies like the COVID pandemic, have pushed the national debt to levels that would have seemed unimaginable even a generation ago. Let's look at the numbers. As of May in the year 2025, foreign holdings of United States Treasuries have topped $9 trillion, up more than 11% in just 12 months. Within this massive total, Japan remains the largest holder, the United Kingdom has surged to second place, and China's stake has sunk to a multi-decade low. Meanwhile, countries like Belgium, Luxembourg, and Switzerland have seen their reported holdings fluctuate, often due to the actions of international custodians and global banks, rather than direct state investment. Why is China pivoting away from treasuries? Beyond the financial calculations, there are deeper strategic motives. In recent years, tensions between Washington and Beijing have flared. From trade wars and technology bans to military posturing and diplomatic disputes. By reducing its exposure to United States government debt, China is insulating itself against the risk of financial sanctions or economic warfare. Diversifying into gold, a universally accepted, tangible asset immune to political pressure, gives Beijing a hedge against future crises or potential dollar-based restrictions. China's appetite for gold has reached historic highs. The People's Bank of China has quietly increased its official gold reserves for more than a year, with monthly purchases that sometimes outstrip those of entire continents. Market strategists like Stefan Gleason of Money Metals point out that China's practice of limiting public disclosures allows it to accumulate gold more efficiently and at lower prices, avoiding dramatic price swings that could result from large, visible purchases. Joseph Cavatoni, another leading market analyst, argues that the true scale of China's gold accumulation may be much larger than reported, hinting at a hidden reserve that could give Beijing significant leverage in future monetary showdowns. This playbook is not unique to China. Other major economies, including Russia, India, and several Gulf states, have also been shifting their reserves away from dollar-denominated assets into gold, commodities, and alternative currencies. This reflects a broader skepticism about the long-term stability of the dollar as the world's reserve currency. In Russia's case, for example, sweeping Western sanctions over the Ukraine conflict have underscored the dangers of holding assets exposed to potential freezes or seizures. For individual investors and everyday citizens, these developments matter more than you might think. If you have a mortgage, a business loan, or even a credit card, changes in United States Treasury yields will eventually affect your interest rates. Higher borrowing costs can slow economic growth, increase unemployment, and erode household wealth. If you invest in stocks, bonds, or mutual funds, you may experience increased volatility as global capital flows shift in response to central bank strategies and geopolitical shocks. Imagine the global financial system as a giant spiderweb, with the United States dollar at the very center. When a key player like China tugs on one strand, by selling treasuries, buying gold, or shifting reserves, it sends vibrations throughout the entire network. Currencies fluctuate, commodity prices swing, and markets react in unpredictable ways. Savvy investors keep a close eye on these trends, searching for early signals that might hint at bigger shifts to come. But it's not just about making money or avoiding risks. For policymakers, the changing composition of foreign debt holders is a wake-up call. The United States' reliance on foreign lenders raises critical questions about national sovereignty and economic security. As more countries diversify their reserves, Washington may be forced to pay higher yields to attract buyers, making future stimulus programs, infrastructure projects, or social safety nets more expensive to finance. Ultimately, this gradual erosion of financial flexibility could saddle future generations with an even heavier debt burden. Let's broaden our perspective. Throughout history, dominant reserve currencies have risen and fallen. The British pound sterling was the world's leading currency in the 19th and early 20th centuries, only to be dethroned by the dollar after the devastation of the Second World War. Some experts now argue that the shifts we're seeing in global reserve holdings could be early signs of another transition, as the dollar's supremacy is slowly challenged by a more multipolar world. Is this the end of the dollar's reign? Not yet. The United States Treasury market remains the deepest and most liquid in the world, and American financial institutions are unmatched in their global reach. The dollar is still the planet's preferred safe haven, but Alicia Garcia Herrero warns that the real danger is not a sudden crisis, but a gradual erosion, a slow leak in confidence that could eventually undermine the dollar's central role. Looking forward, several scenarios could play out. In one, China continues its measured diversification, reducing its treasury holdings at a gradual pace while increasing its gold reserves and shifting into other assets. This would keep markets relatively stable, but force the United States to accept a new reality of higher borrowing costs and less influence over its creditors. In a more volatile scenario, geopolitical tensions could escalate, prompting China to accelerate its selling and dump treasuries in large quantities. This could trigger a sharp spike in yields, destabilize financial markets, and spark a global flight to safety, potentially driving up gold and other alternative assets. Such a move would not only hurt the United States, but could also harm China by devaluing its remaining dollar holdings and disrupting international trade. Alternatively, the rise of other foreign holders such as Japan, the United Kingdom, and various international financial centers could partially offset China's retreat, preserving some stability in the treasury market. However, this would make the system more complex and unpredictable, as the motivations and strategies of these new players are more diverse and less transparent. For example, Japan's holdings are sometimes used as leverage in trade negotiations, as noted by Japanese Finance Minister Katsunobu Kato, underscoring how these positions can be wielded for diplomatic advantage. For everyday people, the lesson is clear. The financial world is in flux, and the old certainties are fading. If you want to navigate this new environment successfully, it pays to stay informed, diversify your investments, and pay close attention to the signals sent by central banks, major creditors, and global markets. Here's a practical tip. Monitor trends in gold prices, foreign exchange reserves, and central bank policy statements. These indicators often provide early warning signs of shifts in capital flows and changes in risk appetite. If you're an investor, consider diversifying not just across asset classes, but also across currencies and geographies. In a world that's increasingly interconnected, resilience comes from flexibility and a willingness to adapt to changing conditions. It's also worth reflecting on how individual countries are positioning themselves in this new landscape. Japan, for instance, continues to hold the largest pile of United States treasuries, using this as a bargaining chip in negotiations with Washington. Switzerland and the Eurozone, meanwhile, are quietly increasing their own gold reserves, preparing for a world that may rely less on the dollar. In the Middle East, oil-rich nations are exploring new ways to safeguard their wealth, from sovereign wealth funds to investments in emerging technologies and infrastructure. Central banks, too, are rethinking their strategies. The recent decisions by major credit rating agencies like Moody's, Fitch, and Standard & Poor's to strip the United States of its AAA credit rating have added urgency to the debate. These downgrades reflect concerns about America's ballooning debt and persistent deficits, reinforcing the sense that the old order is under strain. For policymakers in Washington, the challenge is clear. Reform fiscal policy, restore confidence, and invest in the future. That means not just managing debt responsibly, but also investing in innovation, education, and infrastructure to maintain the United States' competitive edge. It also means engaging constructively with other major economies to build a more stable, transparent, and resilient global financial system. In summary, China's reduced official holdings of United States Treasuries are not a sudden earthquake, but rather the latest chapter in a long story of economic evolution and geopolitical maneuvering. The world is not abandoning the dollar, but the hands holding it are changing. As ownership of American debt becomes more diverse and complex, the need for vigilance, adaptability, and strategic thinking has never been greater. Remember, these shifts affect all of us, whether or not we pay attention to the headlines. The next time you hear about treasury yields, gold reserves, or central bank policies, remember that these are not just abstract numbers. They are signals in the world's biggest financial tug-of-war, shaping the opportunities and risks that define our collective future. If you want to stay ahead of the curve, make sure to subscribe, hit the like button, and click the bell to join our community. We'll keep you updated on every twist and turn in this unfolding drama, so you can make smart decisions and seize the opportunity.